Peace, family. This is a publication that proves that banks do not lend any money. Now, if you read this publication, it's going to explain this right here. The accounting process of how the banks go about funding a loan, right? Now, if you read this is what you're going to find. I'm going to give you an example right here, right? So let's say you want to go to a bank and get a loan, right? Now, first you're going to realize that, especially if you read this, is that banks, they offer a unique service. Their service basically that they offer is basically a monetary contract manufacturing service. So you see that big contract or the promissory note or the loan agreement that's 10, 20, 50 pages, 100 pages long. So they are the ones that manufacture it, all that legalese, all that legal language, right? And it has to be aligned with the regulations of whatever country that bank is in. So they also, what they do is that monetary contracts, when it is deposited at the bank, they actually do the accounting, that's the service, and they deal with the credits and debits of those funds. So they do account management. So let's say you want to go to the bank and you want to borrow $10,000, right? That's what you want to do. Okay. So what they'll do is then they're going to decide if they're going to keep this, right? They're going to keep this and then process the loan, right? So now this right here, if they keep it, first of all, they're going to open an account in your person's name. They call it your name, but it is your person's name, okay? But you remember that. Then what they do is they're going to put that into the account, right? And they're going to open, this is the account number, and they're going to say, okay, what type of product was accounted for, and then wonder what type of currency, and what's the value of the product, what's the value of the contract, 10,000. So they do a journal, an accounting entry, and they credit the account. So as soon as they keep this, they have to ledger that into the account, and it's a journal and it's an entry, and they credit. Now the account has credits just by depositing that. It's like if you give them $20 bills and then you give it to the bank, they have to deposit and ledger it as a credit. Same thing with that. And from that credit, then if you get approved, right, then they do another entry and they just title the entry whatever they want. They could have put Superman right here, but they choose to put loan, and then they give it a number. And then they say, oh, it's a type of product, or they call it other private financing, right? And then what they do is they debit $10,000 because the credit has the account has been credited with the monetary contract right there. So now this debit is then put into the account as a deposit, customer deposit. So when they say, hey, you've been approved, check your account. So what happens is that they debit this, and then they have the account, the loan account, then that becomes what reflects on you, thinking that you have to pay it back. But if you look at the whole financing part of the whole accounting part of it, you're going to realize that what they do is they're just playing with the account. They're just playing with names and numbers. So they have a current account and they have a loan account. These are two accounts. The current account was credited 10,000. This is the accounts overview that they give. And then this is the balance, right? Credit 10,000, and this is one contract. Number of contracts, 1. Then what they do is this is the other account, loan account. They debit. This is a liability. Liability, they debit. So you see, bam, bam, credit, debit, 0. And they got 2 contracts now. So the funding of the loan came directly from this. But the problem is this, right? This is a problem. You say, but shucks, you have to pay back this loan. You have to pay back this loan. Well, the thing is, what happens is that when this was debited, right? When this was debited, this now is denominated into dollars. Dollars. You have to understand dollars. As soon as this created dollars, right? every dollar bill that ever gets manufactured, it cannot be printed by the government, because if it gets, anytime dollars comes into the system, the government has to pay an interest, because the government is the one obligated to pay every single dollar bills created and manufactured and coming into the system, because every dollar bill is an obligation of the government. So if the government goes to get a loan, it's borrowing its own dollar bills. Government cannot print out its own money. So every time the account is credited, it is because of the loan agreement, and it is funding the debits. And then this creates dollars. And because it creates dollars, remember, if a dollar gets created, the government now has to pay an interest on every dollar. So that's why you got to report it to the government. Say, hey, government, hey, guess what? On this date right here, $10,000 was created. And this came in, this is an income to this account right here. Income of credit. And this is how it came in, through this. See the credit right here? The credit instrument, and guess what? I am the owner of that, and I have the beneficial interest in that, and I gave it to the bank, right? I assigned it to the bank because I wanted that to be used to secure this. Dollar bills was created. I gave this to the bank to secure it. So see, this dollar bill is secured by the credit instrument, or the credits. So this is already secured, but you got to let them know. Because if you don't let them know, they got to pay a tax on it, and they don't have money to pay tax. They can get it only from they got to pay an interest, sorry. Every dollar bill created, the government has to pay an interest on it, but they can't pay because they have no money, they don't have none, so they have to collect taxes to pay the interest to give it to the bank. You understand? So whenever anybody goes to the bank to get a loan, you have to give them something to secure the obligations, the liabilities. So there is no money being borrowed, it's all credits and debits. If you want to know more, read this study right here. Professor Richard Warner, Can Banks Individually Create Money Out of Nothing? The Theories and Empirical Evidence. And if you look at the other side right here, is another one. How do banks create money? And why can other firms not do the same? An explanation for the coexistence of lending and deposit taking. Very, very good stuff. Anyway, hope this catches your attention, and hope you can read this right here. Peace.